The performance of the UK economy has been surprisingly strong. A year ago, we and most other analysts were projecting growth of about 1.5% this year, but growth now looks to be about double that. In addition, the recovery is increasingly broadly based. Initially, output growth was being driven primarily by private consumption, which households were financing by reducing their saving. But now we see signs that private investment is also beginning to pick up, as firms have grown more confident about the state of the economy. So overall, we're much more optimistic than we were a year ago, both about short-term growth and about the prospects for the recovery to continue in the medium term, although of course there are always risks on the horizon. Growth in the UK has been accompanied by substantial increases in employment, and that's led to a welcome and very rapid drop in the unemployment rate. Now, unemployment is still too high in the UK, and so there's still room for growth of this type. But eventually it will become impossible for growth to come from continuing to increase the number of workers. And at that point, growth will depend on increasing the amount that each worker produces, or what economists refer to as productivity growth. With faster productivity growth, there'll be a spur to investment and output, and firms will be able to increase workers' wages without triggering inflation. But if productivity doesn't recover, then the output growth will eventually stall. So it's clear that productivity growth is important. What's less clear is why productivity growth has been so slow recently. We think it has to do with structural changes in the UK economy, with some sectors that are shrinking in importance and others that are beginning to take off, and also with lingering effects from the financial crisis, the slow flow of credit to firms as banks have tried to rebuild their balance sheets after the crisis. Now, over time, these factors should work themselves out, and so we would expect to see productivity growth pick up in the future. But this is clearly a topic we'll be paying close attention to, because the path of productivity in the future will determine whether the recovery remains on course or loses steam. Housing prices have been growing very rapidly in the UK recently, and especially in London, and the authorities have pointed to this as a potential source of financial risk going forward. We've seen in the UK before and in other advanced economies how very rapid house price inflation can contribute to financial risks. As house prices rise, families take out ever larger mortgages, and this increase in indebtedness can contribute to risks for both households and financial institutions, because very small shocks to interest rates or to worker wages can make it very difficult for families to pay their mortgage bills. The authorities have introduced some measures to try to deal with this risk. For example, they're introducing a limit on the percentage of mortgages that banks can issue that feature a very high ratio of loan amount to worker income. We think that this emphasis on macroprudential measures as a first line of defense is appropriate, and we also welcome the fact that the authorities are acting early, particularly because it may take some time for some of these measures to become effective. But the fundamental factor that's driving very rapid house price growth in the UK is that demand far outstrips supply. Recent reforms to planning processes should help, but there's more that needs to be done. Reforms to remove unnecessary restrictions to development, to make sure that the tax code encourages the most efficient use of land, and measures to spur the development of a rental market for housing in the UK would be good places to start. So the authorities' concern about rapid house price growth and its potential to contribute to financial risk is well-founded. And dealing with these concerns is going to take a combination of macroprudential measures and structural reforms. Monetary policy should stay accommodative. Inflation is low and stable, wages are growing very slowly, and although output is beginning to pick up, the recovery is still in an early stage, and there's still a lot of slack in the economy. Until we see signs that inflation is picking up, or that the growth of costs is exceeding that of productivity, monetary policy should continue to provide support to the economic recovery. An accommodative monetary policy can also help offset some of the contractionary effects from fiscal policy. The authorities have brought the budget deficit down in the UK substantially in recent years, but it's still quite large at about 5% of GDP this year. Thanks to the recovery in output growth, the fiscal consolidation plan for this year looks appropriate. And over the medium term, fiscal policy should continue to aim at bringing down the budget deficit and putting the debt ratio firmly on a declining path, while also providing support to medium-term growth through adequate investment and protecting social expenditure. Given the scale of the challenge that the authorities are facing, they should be looking at both revenue and expenditure measures to help bring the deficit down. So overall, the policy mix the authorities are following: an accommodative monetary policy that's continuing to provide support to the recovery, and a fiscal policy that's aiming to bring down the deficit over the medium term and put the debt ratio firmly on a declining path, is the appropriate one.